In this lesson, we're going to be covering the big spot trading account. Now, first and foremost, before we get into that, I want to show you this slide, and this is the portfolio structuring example. This is just so you understand where big spot trading fits in within the greater scheme of things. So assume that you have a $10,000 account. Your big spot trading account is going to usually form around 70%. That number doesn't have to be fixed at that. It's completely subjective and up to you, but I recommend this form the biggest part of your trading portfolio. So 70% is your big spot account, 20% is going to be your swing trading leverage account, and 10% is going to be your short-term trading account. Now, the reason why it's set like this is simply due to risk. Once you start to increase your leverage and you trade on a lower time frame with more frequency, with higher frequency trades, you're going to be taking on a lot more risk, which means you don't want to be playing with too much money. When looking at a spot trading account, there's zero chance of liquidation because you're simply trading spot. What is spot trading? It just means that you're buying the underlying asset. So if I say you're buying Bitcoin on spot, it means you simply just bought Bitcoin. You bought Bitcoin in your spot trading account and you can withdraw that onto a ledger. There's no leverage involved. You're not borrowing anything from the exchange. It's yours. You bought it. Same thing as Ethereum, same thing as any other coin. And this is why it's going to form the biggest part of your trading account. You're simply relying on buying low and selling high and participating in the usual volatility of the market and momentum trades to make your money. You're not trying to play small up or down moves and using leverage to make your money. So without further ado, let's get straight into the slide. The next one over here shows, generally speaking, the time frame that I'd be looking at. For the big spot account, it's going to be around your 3-day or weekly, and the point is that you're catching major uptrends. So you can see here, type of trading, trade the uptrend. Buy low, and ultimately when that trend comes to an end, you're going to sell. So let's quickly go onto a trading view chart just to give you a better example. If you consider this chart over here, your aim would be on a big spot portfolio to get in once the trend shifts from down. So in this instance, the trend was moving down. You can see over here, we started to break structure towards the upside. That is all covered in a previous lesson. If you've forgotten or you missed that, please go back and watch that. We covered that in the trend trading lesson. So according to this, you would enter into the trend roundabout over here at about $9,400 using the high time frame chart, and you would be holding those spot positions as price moves higher and higher until such time as the trend eventually breaks towards the downside, which is exactly here when you set in your very first lower high, and that is where you would start to exit into a cash position. So when it comes to your big spot account, I want to use another slide from one of the previous lessons just as a reminder to showcase how this would work in relation to the broader market cycle. So if you have a look over here, these were the 4 main market phases within that one broader cycle which we covered. Ultimately, during this accumulation phase, price starts to oscillate, and once you see a break in structure and price start to reclaim key levels, in other words, showing that it's the very start of the advancing or markup phase of the market cycle, also known as an uptrend. This is where you want to start to get into the market and you want to hold that spot portfolio. That's going to now be 70% of your available trading capital should be allocated into a coin that is moving onwards and upwards. In this instance, we've been talking about Bitcoin. As the market starts to move, you may consider diversifying from Bitcoin into a couple of other coins. It's very important that you understand once the distribution phase of the market cycle begins to take place, because once you start to see the signs and symptoms of this distribution phase, you want to start consolidating that spot portfolio, which may be holding 5, 10, or even 15 different coins into only a few coins. So you're consolidating it down from a large number of tokens into maybe just 1 or 2. And once that structure actually breaks to the downside, which means that you're beginning that declining phase of the market cycle, you should now have that 70% of your portfolio back in USDT or another form of stablecoin. Now you understand the importance of the big spot portfolio. In the next video, we're going to go into the swing trading portfolio, which is where you'd be looking to make money both to the up and the downside. So get ready and I'll see you in the next video.